A few years ago, I was sitting in a cafe with my friends, sipping on my favorite latte. We were chatting about dreams and goals when one of my friends, Josh, mentioned his plan to retire early and travel the world. I was intrigued and asked how he planned to achieve that. "Well, my friends," he said to us, "it all starts with investing." I realized that saving money alone wouldn't help me reach my goals. I need my money to work for me, to grow and multiply. So, I have started educating myself and have also begun taking small steps in gradually building a solid investment portfolio. That conversation changed my perspective on finances forever. From that day forward, I embarked on a journey to demystify the world of investing, and now I'm here to tell you what steps I followed as a beginner to start investing from $500 to now $1.5 million in just 2 years. Diving into the investment world can be intimidating, especially if you're just starting out. With so many options, strategies, and complex jargon, it's easy to feel overwhelmed. In this video, we're breaking down each step of the investing process I took, giving you all the juicy details you need to become an intelligent investor. These steps will help you get a sense of smart choices and build a solid financial foundation. Picture this: you're planning a road trip. Would you start driving without knowing your destination? Of course not. The same principle applies to investing. Before we begin investing, it's crucial to define your financial goals. Setting clear financial goals gives your investments purpose and direction. Take a moment to reflect on your aspirations. Are you aiming to retire early and travel the world? Do you want to save for your children's education? Or perhaps you dream of starting your own business one day? Whatever your goals may be, write them down and be as specific as possible. Having well-defined financial goals allows you to create a roadmap and break them down into manageable milestones along your investing journey. Budgeting is the foundation of any successful financial plan. It's the process of tracking your income and expenses to understand your financial situation and make informed decisions about saving and investing. Take a close look at your income and expenses to understand your cash flow. Start by assessing your income sources. Calculate your monthly take-home pay, including your salary, side hustles, freelance work, and any other sources of income. Be sure to account for taxes and other deductions. This exercise will give you a clear picture of your cash flow and help you determine how much you can comfortably invest. Next, track your expenses. Categorize them into fixed expenses like rent or mortgage payments, utilities, and transportation costs. Then, identify variable expenses like groceries, dining out, entertainment, and discretionary spending. Once you have a clear understanding of your income and expenses, analyze your spending patterns. Look for areas where you can potentially cut back or optimize your budget to free up additional funds for investing. Budgeting is like having a financial GPS. It keeps you on track and helps you allocate your resources wisely. Education is the key to unlocking your investment potential. Investing can feel overwhelming at first. Before you dive into the world of investing, it's essential to educate yourself on the basics. Let's go over a few fundamental concepts that will help you navigate the investment landscape with confidence. First, familiarize yourself with the concept of risk and return. Investments carry varying levels of risk, and higher-risk investments tend to have the potential for higher returns. Understanding your risk tolerance and finding the right balance is crucial. Next, explore the concept of diversification. Diversifying your portfolio means spreading your investments across different asset classes, such as stocks, bonds, and real estate. This helps reduce the impact of any single investment's performance on your overall portfolio and mitigates risk. If you would like to learn more about different assets you can invest in, I have linked a playlist down on the description and up on your left side of this video. Knowledge is power in the world of investing. The more you learn, the more confident and successful you'll become. Life can be unpredictable, and having a safety net is essential. That's why it's crucial to establish an emergency fund, a financial safety net to protect you during tough times. It acts as a shield against unexpected expenses, such as medical emergencies or job loss. Set aside 3 to 6 months' worth of living expenses in an emergency fund before diving into investments. To establish your emergency fund, the following simple 3 steps will be of great help. First, calculate your monthly living expenses. To determine the size of your emergency fund, consider your essential expenses, such as rent or mortgage, utilities, groceries, transportation, and insurance. Next, you need to determine your target emergency fund. Multiply your monthly expenses by the number of months you want to cover. For example, if your monthly expenses is $2,500 and you want to cover 6 months, your target emergency fund amount would be $15,000. Lastly, set up automatic contributions. Set up an automatic transfer from your checking account to your emergency fund each month. Start small if needed, but be consistent. Over time, your fund will grow, providing you with peace of mind. Investing involves risk, and understanding your risk tolerance is crucial. Simply put, risk tolerance refers to how comfortable you are with the possibility of losing money in the short term in pursuit of long-term gains. Higher risk investments offer greater potential returns but also come with increased volatility. To assess your risk tolerance, ask yourself some important questions. How would you feel if your investments dropped significantly in a short period? Would you lose sleep over it? If the thought of such market fluctuations causes anxiety, you may have a lower risk tolerance and prefer a more conservative investment approach. Conversely, if you can stomach short-term market fluctuations and focus on long-term gains, you may have a higher risk tolerance and be open to a more aggressive investment strategy. Understanding your risk tolerance will help you make investment decisions that align with your comfort level and avoid unnecessary stress or panic during market downturns. Imagine a treasure chest where your investments can grow and compound without the burden of immediate taxes. Tax-advantaged accounts are just that, a powerful tool to maximize your wealth-building potential. These accounts offer tax benefits that can boost your savings and help you reach your financial goals faster. The most common tax-advantaged accounts for long-term investing are employer-sponsored retirement plans, such as 401k, and individual retirement accounts, IRAs. Employer-sponsored retirement plans. Many employers offer retirement plans like 401k or 403b. 401k plans are offered by private, for-profit companies, while 403b plans, on the other hand, are offered by tax-exempt and non-profit organizations. These plans allow you to contribute a portion of your pre-tax income, which means the money you invest is deducted from your taxable income. This reduces your current tax liability and allows your investments to grow tax-deferred until you withdraw the funds in retirement. Another fantastic benefit is employer matching contributions. Some employers offer to match a percentage of your contributions, effectively giving you free money. Take full advantage of this by contributing at least enough to receive the maximum matching amount. It's like an instant return on your investment. Individual retirement accounts, IRAs. IRAs are personal retirement accounts that you can open on your own, independent of your employer. There are 2 main types of IRAs, traditional IRAs and Roth IRAs. Traditional IRAs, contributions to a traditional IRA may be tax-deductible, depending on your income and whether you or your spouse have access to an employer-sponsored retirement plan. The money you contribute grows tax-deferred until you withdraw it in retirement, at which point it is taxed as ordinary income. Roth IRAs. Roth IRAs offer a different tax advantage. Contributions to a Roth IRA are made with after-tax money, meaning you don't get an immediate tax deduction. They don't reduce your taxable income in the year of contribution. The beauty of a Roth IRA is that your earnings in the account grow tax-free, and qualified withdrawals in retirement are also tax-free. This can be a huge advantage if you anticipate being in a higher tax bracket in the future. Both traditional and Roth IRAs have contribution limits set by the IRS. Make sure to check the current limits and eligibility requirements when considering these accounts. Also, both employer-sponsored retirement plans and IRAs have contribution limits and eligibility requirements, so make sure to understand the rules and take advantage of these tax-advantaged accounts. Now that you are all set with the basics of starting your investment journey, let's get into the most exciting steps of investing. Don't put all your eggs in one basket is one of the most commonly said phrases when it comes to investing. Diversification is like having a buffet of options. It helps reduce risk and increase your chances of success. So, don't put all your money in one place. This helps reduce risk and maximize potential returns. It's like having a delicious buffet of investments. This step is all about spreading your investments across different asset classes, sectors, and geographical regions. Each asset class performs differently under various market conditions. By spreading your investments, you're less likely to suffer major losses if one particular investment goes south. Here's how you can diversify your portfolio. Asset classes. Consider investing in different asset classes like stocks, bonds, mutual funds, index funds, real estate investment trusts, REITs, or even alternative investments like commodities or cryptocurrencies. Each asset class has its own characteristics and performance patterns, so diversifying across them can help balance out your risk exposure. Sectors. Within each asset class, look at different sectors of the economy. For example, you can invest in technology, healthcare, consumer goods, finance, and so on. By spreading your investments across various sectors, you're less vulnerable to downturns in a single industry. To start investing, you'll need a brokerage account, which is an online platform that allows you to buy and sell investments. There are plenty of online brokerage firms out there, but you want to find one that suits your needs and aligns with your investment goals. Look for a brokerage with low fees, user-friendly platforms, a good track record, and a range of investment options available. Before you commit, do your research and read reviews from trusted sources. Make sure you're comfortable with the platform's features, customer support, and available investment options. Remember, you'll be spending a lot of time on this platform, so choose wisely. Take your time to research different brokerages and read reviews from reliable sources. Popular brokerage platforms include Robinhood, Fidelity, Charles Schwab, TD Ameritrade, and Vanguard. Don't be afraid to open a demo account or reach out to their customer service for more information. Do your research and choose one that aligns with your investment goals and provides a user-friendly experience. You're the boss of your investments, so choose a brokerage that fits your needs. Time to craft your investment strategy. An investment strategy is a plan that outlines how you'll invest your money based on your goals, risk tolerance, and time horizon. When it comes to investing, there are two main approaches: active and passive investing. Active investing. This approach involves actively managing your investments by hand-picking individual stocks, bonds, or other securities. It requires conducting research, analyzing financial statements, and staying up to date with market trends. Active investing can be exciting, but it also requires more time, effort, and expertise. If you're a go-getter who loves analyzing financial statements and staying up to date with market news, active investing might be your jam. Passive investing, on the other hand, takes a more hands-off approach. It involves investing in index funds or ETFs that track a specific market index, like the S&P 500. Passive investors believe in the long-term growth of the market and aim to match its performance rather than beat it. It requires less time commitment and expertise, but can still yield solid returns. If you're more into a hands-off approach and want to ride the market's ups and downs, passive investing could be your cup of tea. So, which approach is right for you? It depends on your personal preferences, risk tolerance, and time availability. Once you have your strategy in place, it's time to put your money to work. Consistency is key in investing. Start investing regularly, even if it's a small amount at first. Time in the market is generally more important than timing the market. This habit will help you develop financial discipline and take advantage of the power of compounding. Suppose you decide to invest $100 per month in a diversified portfolio. Over time, as your investments grow and potentially earn returns, your investment gains will also earn returns. This compounding effect can significantly boost your wealth in the long run. To get started, first, you will need to set a budget. Determine how much money you can comfortably allocate towards investments each month. It's essential to strike a balance between investing and meeting your other financial obligations. After setting your investment budget, automate your investments. Take advantage of automation by setting up automatic contributions from your bank account to your brokerage account. This way, you'll be consistently investing without even thinking about it. Lastly, is the use of dollar cost averaging. It's a fancy term, but all it means is investing a fixed amount of money at regular intervals, regardless of market conditions. This strategy helps smooth out the highs and lows of the market, and over time, it can lead to some sweet returns. By investing a fixed amount at regular intervals, you'll buy more shares when prices are low and fewer shares when prices are high. The important thing is to get into the habit of investing regularly. As your income grows, you can increase your contributions. Now that you've got your investments up and running, but your work doesn't stop there. As time goes on, it's important to monitor your investments and review your portfolio periodically. Market conditions and individual investments can change, potentially affecting your asset allocation. If your asset allocation gets out of balance, rebalance it by adjusting your holdings. To monitor and rebalance your portfolio, set a regular schedule to review your portfolio. This could be quarterly, biannually, or annually, whatever works best for you. During these reviews, assess how your investments are performing and if they align with your goals. After reviewing your portfolio, allocate your asset. Check if your asset allocation is still in line with your desired risk level. Over time, certain investments may perform better than others, causing your portfolio to become unbalanced. If one asset class grows too much, you may need to sell some of it and invest in other areas to maintain your target allocation. Now that your asset is in order, rebalancing your portfolio is necessary. Rebalancing doesn't have to be a complex process. Many brokerages offer tools and resources to help you rebalance your portfolio with just a few clicks. There are a few ways to rebalance your portfolio. You can sell overweight investments and use the proceeds to buy underweight ones. Alternatively, you can redirect future contributions toward the underweight areas until they reach your desired allocation. Rebalancing is not about chasing short-term trends, but about keeping your portfolio aligned with your long-term goals. To be a successful investor, staying informed about market trends, economic news, and changes in investment regulations is essential. If you ever feel overwhelmed or have complex financial situations, don't hesitate to seek advice from a financial advisor. They can provide personalized guidance, help you navigate tricky situations, and optimize your investment strategy based on your specific needs and goals. Investing can be a powerful tool for building wealth and securing your financial future. By following the optimal steps for beginners, you can navigate the world of investments with confidence and make informed decisions. If you found this video helpful, hit that like button, subscribe to our channel, and don't forget to turn on notifications so you never miss a financial update. Remember to stay disciplined, diversify your portfolio, and continuously educate yourself to maximize your chances of success. Till the next video.